Okay, everybody, it's me, Gregory Mannarino. This is my post-market report. As a matter of fact, it's my last report of the week. The market is closed tomorrow, so you will not see me. I will not see you until Sunday. Yes, I will miss all of you. All right, look, so with that said, I'm laughing. I cannot help myself. We got some very interesting things to follow and cover here. Not the least of which is this 10-year yield, which we will put a little light on. Anyway, post-market wrap-up on this lovely Thursday here, April 14th, 2022. So, it's very interesting the way this market reacts to data and then whatever comes out of the mouth or mouths of the things that are running the Federal Reserve. And we're going to talk about that. So this morning we got, more absolutely abysmal economic news. Retail sales missing the mark. Took everybody by surprise, but not you or me. Import prices surging out of control. First-time unemployment claims missing the mark. Imagine my shock. You have no idea how surprised I am. How about no? Anyway, what was surprising today was the move higher in the 10-year yield. We made a nice jump after Fed President Williams opened up his pie hole and explained, I'm laughing, it's too funny. Anyway, it's just astonishing to me. Prior to Fed President Williams opening up his pie hole, this market was off to the races. Stocks were doing great, despite the fact that we got, more bad economic news, and it doesn't stop. But then all of a sudden, we get some information from Fed President Williams. What was that information? Well, that next month, the Federal Reserve could possibly be, hiking the federal funds rate, not 0.25%, but 0.5%, and the market hated it. All of a sudden, not only did stocks sell off here, we got a knee-jerk higher in the dollar, a substantial move higher in the dollar, which hit precious metals, which hit cryptocurrencies here. And then we got this jump higher again in the 10-year yield. Let's talk about that for a moment. So, yes, I am very happy that a lot of you are paying attention to that because I'm getting, my email box. Brrr, hey, Greg, you watched the 10-year yield? Yeah, I'm watching the 10-year yield. And look, we covered right here on this lovely video blog how we would eventually close above 2%. I've been explaining we are going above 3. We are going above 3. Today, the 10-year yield at one point, 2.82. Big move off of the morning low, and that is concerning, not because we moved higher, because we're going above 3. Just mark my words on that. But it's the speed of the move higher, and of course the MMRI, Mannarino Market Risk Indicator, bam, higher as well. Yes, risk is rising in this market. Okay, with that said, let us ponder things here. So if you and I understand that rate hikes are coming, more of them are coming, several down the pike, and we both expect that the 10-year yield is going to settle above 3, okay, and we're going to get turbulence in the market on the way there, meaning, stocks going all over the place, especially tech. Look what happened to tech today. So early on, stocks higher. After the announcement from Fed President Williams that the Fed will be, more than likely raising rates a 0.5%, and we should expect that come next month here, everything kind of flipped around like in a blink of an eye. And that did, again, spike the 10-year yield, and that hit the tech sector. The tech sector is very rate sensitive. You all know this. I've covered it before. But look, understanding where we're going, this shouldn't rattle you. Again, we have a market that's really not too far from record highs here. And the easy money is not going to stop. Despite what the Fed may be doing to the federal funds rate, the easy money is going to keep pouring in. Not only that, all of these, and there's several big, crises going on right now. This war being the biggest, and more and more and more cash is going to get thrown at it. We're in the tens of billions. We're going to be, of course, much higher than that. $1 trillion is definitely, I think, the goal here. Maybe even more than that. I mean, who knows what they're going to do? The longer they prolong the war and every other crisis, again, with regard to COVID alone, there's $1 trillion, look this up for yourself, $1 trillion left in the budget to spend on COVID, and they will spend it. It's already there. So it's going to get allocated to whatever they want. And they're going to, of course, sell you more vaccines and pills and everything else. Big pharma is just going to be smiling all the way to the bank. And I think we all understand that. But this is what makes things laughable here. Let us move forward. So I cover the market, right? Pretty substantial move here in the 10-year yield. Is that a yellow flag? I'll tell you something. I don't like a move that big, but we're going above 3. So the key here is to understand, the takeaway is the 10-year yield will be above 3 shortly. I just count on that happening. And if it's done the right way and it doesn't, get out of control, we're all right. We're still okay here. But what are we watching for? An uncontrolled spike. If we go 3, 3.25, 3.5, 4, bang, 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 very rapidly, then that's it. Then cash is going to be bleeding out of the debt market, putting a lot of pressure on the stock market. Stock market's going to sell off hardcore. Not just, several hundred points, but thousands of points. And then all that cash is just going to move. It's going to move into commodities, as I've been explaining to you, into cryptocurrencies, I believe, as well. So we want to be on the right side of that, of course. Anyway, so this is a little news we got out of the White House. This came out yesterday. I forgot to cover this. Now listen to this. The White House is saying that the trillions of dollars, literally trillions, that they have spent on fiscal stimulus and everything else is not causing inflation. Oh no, it's not the fact that that the fake government, inclusion with the real government, which is the Federal Reserve here in the United States and around the world for that matter, all the central banks collectively are the one world government. We all know that. But this has nothing to do with surging inflation. You see, what they won't explain to you is very, very simple. Every dollar they create out of thin air must steal its purchasing power from every other existing bill in whatever form it may exist. When they make or create a dollar, okay, it doesn't automatically become worth a dollar. No, it has to steal a fraction of a fraction of a fraction of a fraction of value from every other existing bill in whatever form it may exist in, whether it's real, printed, or a digital one. And that is obviously a massive diluting effect, creating inflation. But they won't tell you that. The fact is the Fed is ballooning and continues to balloon the money supply by design. So they can raise rates all they want to until they stop ballooning the money supply and they actually stop buying assets and stop funneling dollars. This inflation is going to continue to rage and get much, much worse. But you see, you're not allowed to know that. Very sad. So it's kind of funny here. Oh yeah, no, White House. No, the trillions in fiscal spending it's not causing inflation. Yeah, okay, sure. Now, with regard to this Fed Williams thing next month, I wouldn't be banking on this 0.5 point rate hike. He's saying it's possible, and he's not the only one. But look, we'll see when we get closer. But in my view, we're probably looking at another 25 basis points. Could be a half. All right, but just count on that 10-year yield going above 3. Just that's the takeaway here. Let's see here. This is interesting economic news too. So export prices are rising at their fastest pace ever. Meanwhile, import prices are also rising at 12.5% year over year. I think we can tell if any of us who are buying things or going shopping. Pretty interesting. Now, here's something else that's interesting. Investor sentiment on the stock market just hit a 30-year low. Now, that is interesting. Now, why is that interesting? Well, to me, as always, because I'm contrarian. I am always a contrarian. When I hear that stock investor sentiment is at a 30-year low, I can't help it. I become more bullish. I'm telling you, I become more freaking bullish. So we'll see. We'll see how that plays out. Now, I did forget to mention crude oil. Crude oil, people, continues to march higher as well as natural gas. And this trend is going to continue for as far as the eye can see and farther than that. How do you capitalize on that? Many ways. I happen to like oil and gas producers. I've been saying this for the longest time. And oil and gas producers, I have this all listed for you right here on my website, traderschoice.net. Ticker symbols are there. They're going much higher in this environment. You got to have some of that in your portfolio. You should also own consumer staples. They've been doing very well. Also listed on my website. Banks, terrible. They're not doing good. We all know that. But again, I still believe in this rising rate environment, you need to at least have some of these in your portfolio. Currently, I own JP Morgan, Goldman Sachs, Bank of America. I added to Goldman Sachs today. I actually bought IBM today as well. Anyway, I like to keep all of you informed. Now, lastly, before I let you go, I started off this lovely blog explaining to you that tomorrow the market is closed. So we get a day off. I like to disconnect myself from this freak show once in a while. As you all know, it gets to me. My blood pressure goes to the freaking moon. One day I'm going to blow a gasket. There's just no doubt about it. Anyway, with that said, people, I'm still going to leave you off with my favorite three things. Are you ready? Let's do that. Bring it in. Bring it in. Love each other. Care about each other. Be charitable. People, this guy here loves all of you a lot. I mean that. Please share the video. Get it out there. Comment. I want to hear from you. I love hearing from you. And I will see you on Sunday for my markets. A lovely look ahead. And it's going to be lovely, of course. Have a great weekend.